Welcome to the Deep Dive. Today, our mission is to cut right through the Utah Commercial Real Estate Q4 2025 Market Report. We're going to pull out the most important insights for you, the learner, in a market that feels, well, both incredibly resilient and under some serious pressure at the same time.
And that resilience part it's really the foundation for everything. The macro story for Utah is just extraordinarily robust.
Right.
I mean, we're looking at a projected 2025 real GDP growth of 3.3%. That's more than double the national rate of 1.5%.
Double. That's huge.
Yeah, and unemployment is holding steady at 3.3%, which is, a full point lower than the national 4.3%.
So let me just boil that down. Utah is accelerating while much of the country is maybe tapping the brakes. But the report says that despite all this strength, the market is bifurcating. We're seeing two totally different stories play out.
Exactly. Let's start with industrial. What we're seeing is not some kind of demand collapse. It's more of a rapid normalization. And it's driven really entirely by a glut of new supply hitting the market. The geography tells the story perfectly. Salt Lake County's main vacancy number looks a little high. It's 7.1%.
But that's just the headline, so what's the real story underneath?
Well, just look north. Davis and Weber counties are still exceptionally tight. We're talking only a 1.9% vacancy rate.
Wow.
But here's the crucial detail for you. If you take out the massive, large-scale bulk distribution centers, the vacancy rate for everything else averages just 2.5%. The opportunity is clearly in that small bay industrial space.
That is a huge distinction. Now, if we pivot to office buildings, we see this incredible division. Why are the newest, flashiest buildings doing okay while everything else seems to be struggling?
It's the flight to quality. Companies are shrinking their overall footprint, but they're upgrading the space they decide to keep. The Q3 2025 data is just dramatic proof. Vacancy in new, post-2015 Class A plus buildings is at 16.9%.
Okay, so now compare that to the oldest buildings.
For pre-2000 Class C buildings, the vacancy skyrockets to 28.3%.
That is a massive chasm, an 1,140 basis point gap. So for you listening, that's an 11.4% difference in vacancy between the newest and oldest offices. The oldest ones are basically becoming obsolete.
They are.
That sounds like a disaster in the making. That much empty space requires some radical thinking. I hear adaptive reuse thrown around, but isn't converting an old office into, say, housing just ridiculously expensive? Is this a real solution?
It is absolutely expensive, but it's becoming necessary. We're seeing it happen with projects like the historic Judge Building in the CBD. It's being converted directly into affordable housing. So while it's costly, it's looking like the inevitable path for some of these challenged assets.
Okay, let's unpack what seems like the most contradictory market of all. Multifamily, you've got these amazing long-term growth drivers, but it's a deep tenants market right now. Landlords are offering up to 3 months of free rent, plus $3,000 gift cards. I mean, that sounds like panic.
It's a temporary velocity war. Here's the paradox. Rents are down 8.25% from their peak, but the underlying demand is actually outpacing new supply.
Wait, say that again?
Year-to-date demand, which we measure by net absorption, that's just the number of units actually filled, was positive 3,241 units. But new deliveries were only 2,172 units.
So hold on. How can demand be higher than supply, but rents are crashing?
Because too many new buildings are opening and trying to lease up at the exact same time. This glut of new options is forcing every existing building to drop their effective rents just to keep the tenants they already have.
So it's a short-term traffic jam, basically, a supply bottleneck that's running head-on into Utah's long-term housing crisis. So once this wave is absorbed, maybe in 2027 or 2028, we should probably expect rents to start climbing again, and fast.
And from a capital markets perspective, the cap rate data for the first half of 2025 really gives you the market's risk map. A cap rate for you is just the expected rate of return on a property.
Right.
We see very tight, confident cap rates for industrial at 6.00% and multifamily even lower at 5.40%.
Okay, now contrast that with the office sector.
Investors are demanding a massive 9.75% cap rate to buy an office asset.
That 375 basis point spread between industrial and office, I mean, that really quantifies the risk, doesn't it? It tells you investors demand almost 4% more in returns just to stomach the uncertainty of owning an office building today.
It's all right there in the numbers.
Okay, before we close, here's one final provocative thought for you. The retail sector, which everyone assumed was dying, is actually having a quiet renaissance in Utah, driven by that population and job growth. Projects are leasing up before they're even built. So think about this. What other U.S. markets are avoiding the so-called retail apocalypse for the same reason? And what does that signal to you about where to invest next?